Capital Budgeting Basics. Welcome to MBA in a Can, where we simplify essential business concepts into clear and practical insights. In this financial management series, we're diving into the fundamentals of how businesses handle money, make investment decisions, and evaluate performance. Knowing the difference between operating expenses and capital expenses is essential for making smart financial decisions, especially when it comes to capital budgeting. Opex refers to the ongoing costs of running a business, like rent, utilities, or employee wages, expenses that are recurring and tied directly to daily operations. Capex, on the other hand, involves larger, long-term investments in assets like equipment, facilities, or new technologies, which provide value over several years. This distinction matters because it influences how these expenditures are funded and evaluated. Opex is usually covered by operational cash flow, while Capex often requires more significant financial planning, using retained earnings, long-term loans, or equity financing. Capital budgeting focuses specifically on Capex, and is a way for businesses to inform decision-making about these long-term investments. By understanding the trade-offs and financial implications of capital expenditure decisions, companies can ensure they allocate resources effectively to drive growth and profitability. Now, let's dive into the basics of capital budgeting and how it helps businesses make informed investment decisions. Capital budgeting is the process businesses use to evaluate and decide on long-term investments. These investments often involve significant expenditures, such as purchasing new equipment, building facilities, or launching a new product line. The goal is to determine whether these investments are financially worthwhile and align with the company's strategic objectives. At its core, capital budgeting is about balancing costs, risks, and returns, ensuring resources are allocated efficiently to prioritize projects that offer the greatest potential for growth or profitability. It begins with identifying potential investments. Companies consider options like upgrading equipment, expanding into new markets, or developing innovative products. Once opportunities are identified, they estimate the cash inflows and outflows associated with each project, including initial costs, ongoing expenses, and expected revenues. Accurate cash flow estimation is critical, as it forms the foundation for all further analysis. To evaluate these projects, businesses use financial tools like net present value, NPV, which calculates the value of all future cash flows in today's terms. A positive NPV indicates the project is likely to add value. Another tool is the internal rate of return, IRR, which shows the expected return of the project. It's compared to the company's required rate of return to assess feasibility. The payback period helps measure how quickly an investment will recover its costs, providing insight into the risk of the project, while the Profitability Index, PI, compares the value created relative to the initial investment. Once analyzed, businesses prioritize projects based on their goals and available resources. For instance, a company might choose a project with a high NPV for long-term profitability or one with a shorter payback period for quicker risk recovery. After selecting the most viable option, the project is implemented and monitored to ensure it stays on track. Regular reviews help address deviations and adapt to changing circumstances. A practical example is a manufacturing company deciding whether to invest in automated machinery. The initial cost might be $500,000, with expected savings of $150,000 annually for 5 years. Using tools like NPV and IRR, the company can calculate whether this investment generates a sufficient return. If the results are favorable, they proceed; if not, other options are explored. Capital budgeting provides a structured approach to making informed decisions about large investments, balancing risks and returns for long-term success. However, it's important to remember that these tools rely on assumptions and projections. Market conditions, unforeseen risks, and changes in costs can all impact outcomes. Businesses must regularly revisit and adapt their strategies to stay aligned with reality. Understanding capital budgeting equips businesses with the knowledge to make smarter investment decisions, driving growth and profitability. That said, businesses and individuals should consult with qualified financial professionals to address their specific circumstances and ensure decisions align with their goals and financial situation. Thanks for watching MBA in a Can. If you found this helpful, please like, subscribe, and share it with your friends and colleagues. Check the description for links to useful sources on the topic. See you in the next video.